Alright guys, let's quickly take a look at the week ahead. Now I hate to be the bearer of bad news, but it's going to be a pretty boring week on the data calendar this week at least. Apart from that, this week is similar to last week where markets will have a lot of idiosyncratic stuff to worry about, especially on the political side with the French and the UK elections. We've got the US presidential debate coming up as well. And on the flow side, we've got month-end and corporate month-end flows coming up this week as well. To make things a little bit simpler to follow along with, I'm going to split the week ahead video into two parts this week. One for the economic data alone and the other one for the more idiosyncratic drivers like the politics and the month-end flows, etc. Just to be aware of for the week ahead because they can impact markets this week. So let's get stuck into it. For this video, we'll cover the economic data side of things, looking at the basic economic calendar. Now, the first thing we need to pay attention to a little bit later in the session will be that BOC Macklem. We do have a lot of central bank commentary coming up, obviously, today, but we've heard a lot from various Fed members, various ECB members. It'll be interesting to hear whether we get anything new from Governor Macklem, especially after the recent data that we've had. The Macklem comments is something I'm interested in, but his comments would have been so much better, so much more impactful had they occurred after tomorrow's CPI data. So I don't think he would have much new to say without having that new batch of CPI data, but there is a chance that maybe he's seen that data already. Because they do sometimes get that information a little bit ahead of us. So it's important for us just to keep an eye on that, I think, a little bit later to what he has to say. If he sounds massively, dovish on the inflation side, or more hawkish, more careful on the inflation side, maybe that's a potential giveaway as to the inflation data that we'll be waiting for tomorrow. Now, that then brings us to the next or first key economic data point for this week, which will be that upcoming Canadian CPI data scheduled for tomorrow at 1:30 UK time. Traders will be eyeing this data to basically assess the probability of a next possible cut. The next meeting for the bank takes place a little bit later in July, coming up on the 24th. Currently, the pricing for that is sitting at 66% probability for a cut. So markets will be eyeing this inflation data because remember, Governor Macklem told us that if they were to see a similar type of deceleration or continued deceleration in the inflation trend, that they would be open for more cuts. So that's going to be important. That July, whether we get a cut or not, it's going to largely come down to what happens to this inflation print tomorrow. Now, the Canadian dollar managed to grind out some decent gains last week, and there's a lot of participants, talking about the front-end rates differentials that we saw and talking about equities that rallied. But let's be honest with each other, guys. It's all about positioning at the end of the day, in my opinion. We got to some seriously stretched positioning that we looked at 2 weeks ago. Now, just keep in mind, this chart that we're looking at is not updated with the most recent information. Remember, we get this data normally on a Friday. We didn't get it on Friday because it was Juneteenth last week on Wednesday. So we'll only be getting the updated CFTC data released a little bit later today in the North American trading session. So just keep that in mind. So this is lag data. We might have seen this move a little bit higher already, but we might actually see it moving even a little bit lower. We'll need to wait and see. But the bottom line is, whether we do see a bit of a move to the up or to the downside, positioning was at record levels or very close to record levels on the short side. At some stage, seeing a little bit of mean reversion in that just wouldn't have been a surprise. So I'm not putting anything that we saw last week for the Canadian dollar down to other types of drivers out there. In terms of short-end rates, it hasn't really driven the CAD as a key driver for a while now. Yes, it's had an influence, don't get me wrong, but it hasn't been a one-for-one driver. So it would be weird if the CAD suddenly decided to follow that, as the grass last week, instead of just focusing on it over the course of the last few months now. I think it's more likely that it was just a little bit of positioning unwinding that took place for the Canadian dollar. Now, turning our attention then to the May data for CPI coming up. Let me just quickly go to that chart. Looking at the historical, always important. Just give me a quick second to open that up. Here we go. So if we quickly take a look at the data, The May inflation is expected to show a continuation of the downside momentum. Estimates right now is pointing to the year-over-year headline inflation to drop to 2.6 from the prior of 2.7. Now, this cooling trend has, again, it's already prompted the bank to cut policy by 25 basis points, right, at their June meeting. The BOC is keen on getting price stability back on track, and obviously with inflation easing further, should we see that, further cuts are likely in the coming months, with markets already fully pricing in another 2 cuts for the year. If we quickly take a look at pricing expectations here, you can see that we are fully pricing in 2 cuts. Governor Macklem told us that they are keeping a close eye, again, on the balance between demand and supply, inflation expectations, wage growth, corporate pricing behavior. But at the end of the day, we all know it's down to inflation, right? They've hinted that more cuts are coming if inflation continues to slow. However, there is a small chance that, if the upcoming data shows a big upside surprise for whatever reason, nobody's expecting that, but that's exactly the point. If we do see a big upside surprise for whatever reason, the BOC might choose to just hold off until we get to the September meeting for another cut. But if we assume that we do get what is priced in, we do get that deceleration down to 2.6, maybe even a little bit lower, then that should see that, 66% probability for a cut in July probably increase to around, let's say, 70, maybe 80, maybe even higher. And that, theoretically, right, should lead to downside for the Canadian dollar. But I'm not so sure how much downside the CAD will see on the back of a marginal miss like that. Yes, a miss should increase the odds of a July cut for sure. And because we're not even at 70%, maybe there is some downside to be priced in there. But if you consider positioning once again, I just think that there's so much bad news priced for this currency. We've got 2 fully priced cuts at this stage. Going from negative 16 basis points to negative 25, i.e. fully pricing in a cut for July, I don't see that as being that amazing trigger for more downside for the Canadian dollar. So I wouldn't be looking to short the CAD if we get a miss. I'll actually be looking to look for some short-term mean reversion upside in the Canadian dollar, should we be so lucky to actually get an upside surprise. Again, it's unlikely, but I wouldn't be looking to press shorts if we got a miss in the data. It just feels like a lot of that is already reflected in the price. Now, don't get me wrong, if for example, if we go back to that inflation chart, if this thing goes from 2.7 and we were to drop all the way down to like 2.2, maybe the 2% mark, then maybe the markets don't fully price in 2 cuts. Maybe they start pricing in 3 cuts. Maybe they start pricing in July and September and maybe December, or September, October, December. There's a lot of different ways they can skin that. So let's just see how it plays out. But I think the miss would need to be absolutely substantial to see us go from 2 fully priced cuts to 3. I don't see that as the more likely scenario. I see more likely scenario seeing a small miss, and the market's basically just shrugging that off, saying, yeah, okay, fine, we've already priced that. That's not going to be too much of a surprise. So that's the first one we'll be watching in the week. Now, the other one we'll be watching coming up on Wednesday, another CPI print, will of course be the Aussie monthly CPI data. Now, the RBA last week, they kept interest rates steady, as you guys know, at their meeting, but there was some chatter from them about potential rate hikes due to persistent inflation concerns. Now, even though the Aussie has strengthened massively across the board on those comments were very much in line, very similar to the comments that they made during the May meeting. The only real difference was that Governor Bullock actually said that the possibility of a rate cut wasn't discussed at last week's meeting. But, it's not like the markets was expecting them to discuss rate cuts anyway. The markets knew that the decision would be between a hold and potentially contemplating hikes. So, the fact that the Aussie reacted that way was really strange in my view. The Aussie saw a lot more strength than I thought was warranted based on the RBA decision last week. Now, in terms of this week's CPI, some participants are expecting the month-over-month measure. Unfortunately, we don't have any estimates right now, but are expecting the month-over-month measure of headline inflation to show a flat reading, basically a 0 print. That'll be largely down to seasonal discounts on holiday expenses, clothing, as well as a dip in retail gasoline prices. However, the year-over-year measure is actually expected to nudge up to 3.8% for the weighted CPI year-over-year from to 3.8 from 3.6. And that would be, if you go to this chart, that would be the highest CPI reading going back all the way to November last year. So anything above the prior reading really is already going to be on our way to that November level, which is a little bit of a concern because we are starting to see that slight acceleration to the upside here for CPI. Now, just, as a side note, for those of you who care about the nerd stuff like I do, the monthly CPI indicator actually only covers about 60% of the quarterly CPI data. So there is always uncertainty about how accurate this data will be in relation to those quarterly data points. And we know the RBA, they really focus on the quarterly data points, but even the quarterly data points for them, they told us that it's not something that, we should take too seriously. Let me show you guys what I'm talking about. Let's quickly go to, let me quickly open up the comments we had from them. Sorry guys, it's going to be worth just quickly going through this. Let me just quickly open this up. Here we go. So if we quickly take a look at the comments we had from Bullock. Now this was all last week, right? Now if we take a look at some of these comments, what I just mentioned about the quarterly data, even though it's important, she even said, listen, we need to look across the broad economy, not just Q2 CPI data. They also stressed that, they're not saying that the case for a rate hike is increasing. And she also said that their use of the word vigilant doesn't mean that an interest rate hike is coming. But I mean, obviously, the way that the Aussie moved last week, it does suggest that markets only really had ears for these blue lines as opposed to the more dovish ones or more balanced ones, which probably does mean that if we do or were to get any number that's close to 4%, which is the market's maximum, that could see the markets rattled a little bit, and that could potentially see expectations, maybe increase for a possible hike. Not necessarily that we're going to get one, but from a market expectations point of view, that could see the possibility for an August cut increase, I would think substantially if we get to 4%. I mean, personally, I'm not sure whether a move to 4% guarantees us a hike from the bank, especially with the bank stressing that, take a look at what they said last week. They said here that momentum in economic activity is weak, including slow growth in GDP, a rise in unemployment, and slower than expected wage growth. They're not all positive. They're not all ass to grass. Yeah, if inflation surprises, we're going to hike. So I'm not sure whether 4% from a central bank point of view will be enough. I think it probably means interest rate stays higher for longer, no doubt. But I think the better play for them from a bank point of view would just be to play higher for longer instead of forcing more hikes. But obviously, in the price actions defense that we had last week, the RBA has maintained a hawkish composure. So I suppose a hike, it's not impossible. And they did tell us that they did discuss it. But even though I think if they go through with something like that, I think it will be a policy mistake. But again, what I think is irrelevant. The only thing that matters is how the markets will react to it. And obviously going into a week like this, after the massive amount of upside that we saw last week, I mean, take a look at the Aussie on the currency index basis. The Aussie had a ripper of a move last week. So obviously the most attractive opportunity, the best low-hanging fruit would be a massive surprise miss in the data. It looks unlikely that we get that, but obviously, again, if we then do get a miss like that, I think that'll be the best opportunity to trade. If we get a 4% or higher, it probably puts, at least from a market's point of view, hikes back on the table. But again, I'm just not sure whether I don't know whether I want to chase the Aussie higher on that, but that'll be a pretty good reason to do so if you wanted to. So that's obviously going to be a key focus for us on Wednesday as well. Then moving on to Thursday. Thursday is going to be a busy day. We get quarterly GDP out for the US, as well as another batch of jobless claims. Now, when it comes to GDP, I know I sound like a broken record, but guys, there is arguably very little new information that markets can get from this report this week. The timeliness is just so terrible. I mean, think about it this way. This is the third and final update to GDP for the first quarter, right? We are a couple of days away from going into quarter 3. I mean, so talk about, something being old news. This is basically that. Having said that, the markets have shown some surprising sensitivity to upside or downside surprises in that quarterly PCE number, despite the fact that the markets knows that it's old news. So the data, it will be interesting to watch. And, if we do get a massive deviation, especially in line with jobless claims, that could be market moving. Both of these will be important because, the markets right now are trying to figure out where US growth and inflation is headed next. There's a lot of question marks about it because the soft economic data, your survey measures, things like the PMIs, that saw a super solid beat on Friday. But if you look at the your more hard data across the board, the picture is clear that there's definitely slowing going on in both growth and inflation and in the labor market. So there's a little bit of, the market wants to see what happens. So they will be paying attention to this. But again, keep in mind, that's going to be Q1 data. Now that moves us then on to Friday's, let me just quickly see where we are. Here we go. Friday's GDP data for the pound. Again, it's Q1 data. So probably not going to be too surprising or too market moving. I think the main focus, the deeper and deeper we go into this week, will actually be the UK election coming up. And I will have more to say about that in the follow-up video to this one. So I'm going to skip that GDP for now. Let's take a look then at PCE data coming up for the US. Now, attention will turn to this data on Friday for the month of May, because we also have personal income and spending data coming up alongside it. Even though the Fed's latest projections only, hinted at one rate cut by the end of the year, the markets aren't buying that right now. The markets, if we take a look at expectations, the markets are still betting comfortably, very comfortably, at very close to 2 cuts by the end of the year, with about a 70% chance or so of the first cut happening in September. The reason for that is the softer, we just spoke about it, the softer growth data that we've had, the labor data that we've had, the softer than expected CPI and PPI data from May, basically sets up a very potential, I would say, tame reaction to the core PCE data. Because again, what needs to happen in this data to change the market's view? Analysts expect the core month-over-month to tick up to, I think, 0.1. Let's quickly go there. I think they're expecting it to tick up to 0.1 for the core measure, which will bring the core year-over-year rate down to 2.6 from 2.8. This cooling in inflation, it fits with the Fed's recent comments about needing to see consistent drops in inflation before thinking about cutting rates. And it also pushes back against their own projections of just 1 cut by the end of the year in that recent dot plot. Now, in terms of market reactions, this is where it gets a little bit tricky this week, because, over the course of the last 2 weeks, with all of this geopolitical stuff that's going on right now, we just really haven't seen the US dollar trade in line with US economic data. We just haven't seen that. If you take a look at this chart over here, we've looked at this many times over the course of the last 2 weeks now, but, the dollar has really been driven by risk premiums in the Eurozone. And as long as that's the case, and as long as the PCE data doesn't throw a massive spanner in the works, I just don't see this being a major event for the markets this week. I think the closer and closer we get to that first round of the French elections on Sunday, obviously followed by the UK elections next week, I think that's really where a lot of the focus will be. So, in a nutshell, even though PCE, even though it's the Fed's preferred measure of inflation, and even though it can create some volatility, whether it comes in higher or lower by a small margin, I don't think that will move much. And even if we get a really big deviation, the risk is that the dollar just chooses not to focus on that and just chooses to focus on risk sentiment instead, which we've seen over the course of the last 2 weeks. So I think we need to be really careful with that PCE data. And we also obviously have month inflows to worry about on that front as well, but I'm not going to talk about that. We'll touch on that in the next video, but that's just something worth keeping in mind. Now, in terms of other events just to keep on the radar, we do obviously still have earnings season going on. Look, these names are not massive, but the names that the markets will be focusing on very keenly in this week's session will obviously be Nike. And let me just quickly show you guys, we actually have the updated expectations for both Nike as well as Micron Technology coming up. So maybe just take a snapshot of that, looking at the quarterly EPS and revenues. This is only really applicable to those of you who are trading these names as individual stock traders. For us who are more focused on the index-based flows, these names really don't matter. It's not something that I will be focused on at all. It's all still about NVIDIA right now, right? It's all about them, all about NVIDIA. It's just had such a monster of a run. Not just, this month or this quarter, but this year. I mean, we are up year to date, even with the recent drop. We're still up over 150% for a, $3 trillion US market cap stock. It's just, it's eye-watering looking at these things. So as long as these big movers are in play, I just don't expect those smaller ones to have any bearing on the markets. But again, from a single stock trader perspective, those are the names that the markets will be most focused on in the week ahead. So that's just a quick look at where we are from a data and risk event point of view. I will cover the more idiosyncratic risks we have this week in the follow-up video.